Preparing for a Bank of Canada graduate interview questions and answers interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work at the Bank of Canada? I want to work at the Bank of Canada because its research directly influences economic conditions for households and businesses. My economics training has made me especially interested in how inflation, employment, and financial stability interact. I would value the opportunity to combine rigorous empirical analysis with practical policy work. The bank also appeals to me because decisions require collaboration across economists, analysts, and operational teams, rather than relying on one perspective. While answering, connect your academic interests to the bank's public mandate, emphasize evidence-based analysis, explain your interest in Canada's economy, and show that you value teamwork, integrity, and policy impact. Question 2. What is the Bank of Canada's mandate? The bank's primary mandate is to promote the economic and financial well-being of Canada. In practice, monetary policy focuses on maintaining low, stable, and predictable inflation, with a 2% target midpoint and a control range of 1% to 3%. The bank operates with a flexible exchange rate and considers employment and output when setting policy. It also contributes to financial stability and provides key services to the financial system and government. Make sure to cover the inflation control objective, the 2% target midpoint within a 1% to 3% range, the flexible exchange rate, and the broader role of supporting economic and financial stability. Question 3. How does the Bank of Canada control inflation? The bank primarily influences inflation by changing its policy interest rate. Higher rates raise borrowing costs, encourage saving, reduce demand, and can lower pricing pressure over time. They may also support the Canadian dollar, reducing imported inflation. The process is not immediate because monetary policy works through households, firms, credit markets, and expectations with significant lags. Rate policy cannot directly create supply, so the bank must distinguish persistent demand inflation from temporary supply shocks. In your answer, discuss the policy interest rate, transmission through borrowing costs and demand, inflation expectations, exchange rates, and the importance of recognizing policy lags and supply-side limitations. Question 4. What factors would you consider when recommending an interest rate decision? I would begin with the inflation outlook rather than reacting to one monthly release. I would examine core measures, inflation expectations, wage growth, demand, labor market slack, and the output gap. I would also assess credit conditions, housing activity, the Canadian dollar, commodity prices, and global growth. Finally, I would compare the likely costs of moving too slowly or too aggressively, communicate uncertainty clearly, and recommend the decision that best anchors medium-term inflation. Be sure to mention core and headline inflation, inflation expectations, labor market conditions, output gaps, wages, financial conditions, exchange rates, global developments, and the risks surrounding the economic outlook. Question 5. How would you explain the transmission mechanism of monetary policy? The transmission mechanism describes how a policy rate change affects the economy. A rate increase typically lifts market and borrowing rates, reducing consumption and business investment. Lower demand can ease labor market pressure and price growth. The exchange rate channel may also affect exports and import prices, while communication influences expectations. The effects differ by borrower, lender, and sector, and unfold gradually. Understanding those channels helps policymakers judge both timing and magnitude. Focus on the sequence from the policy rate to market rates, borrowing, spending, investment, employment, exchange rates, expectations, and ultimately inflation, while noting that effects vary across households and firms. Question 6. What is the difference between headline and core inflation? Headline inflation measures the overall change in the consumer price index, including volatile items such as gasoline and food. Core inflation uses statistical or conceptual approaches to reduce the influence of temporary price movements and reveal persistent trends. I would monitor both. headline inflation matters for household purchasing power and credibility, while core measures help assess underlying momentum. Neither is sufficient alone, so I would interpret them alongside expectations, wages, demand, and supply conditions. Make sure to distinguish the broad consumer price measure from underlying measures, explain why volatile components can distort short-term signals, and note that core inflation is informative but not a replacement for headline CPI. Question 7. How can a central bank respond to a supply shock? A supply shock, such as an energy price surge, can raise inflation while weakening output. The bank cannot directly restore the lost supply, so it must assess whether the shock is temporary or becoming embedded through wages, expectations, and broader pricing. A mechanical rate response may unnecessarily damage demand, but ignoring persistent effects could unanchor inflation. I would recommend policy that keeps medium-term expectations stable while acknowledging the short-term output trade-off and communicating the uncertainty. In your answer, explain the difference between first-round price effects and persistent inflation, discuss inflation expectations and second-round effects, and recognize the trade-off between stabilizing prices and supporting output. Question 8. What is the output gap, and why does it matter? The output gap is the difference between actual economic output and the economy's estimated potential output. A positive gap suggests demand is exceeding sustainable capacity and may create inflationary pressure. A negative gap indicates unused resources and weaker demand. It matters because monetary policy affects demand, not potential supply directly. However, potential output is unobservable, so estimates are uncertain and should be combined with labor market data, business surveys, wages, and inflation indicators. Cover the difference between actual and potential output, explain positive and negative gaps, connect the concept to inflationary pressure, and acknowledge that potential output is unobservable and must be estimated. Question 9. How would higher interest rates affect the Canadian housing market? Higher rates usually reduce housing affordability by increasing mortgage payments and lowering the amount households can borrow. That can weaken home sales, prices, construction activity, and related consumption. The effects are uneven because borrowers refinance at different times, mortgage structures vary, and housing markets differ across regions. Higher rates may also worsen rental affordability if supply responds slowly. I would therefore evaluate housing not only as an inflation channel, but also through household vulnerability and financial stability. Be sure to discuss mortgage payments, affordability, housing demand, construction, household balance sheets, rental markets, regional differences, and the potential implications for consumption and financial stability. Question 10. What is quantitative tightening, and how can it affect the economy? Quantitative tightening reduces a central bank's balance sheet, commonly by allowing securities to mature without reinvestment or by selling assets. This can place upward pressure on longer-term yields, reduce liquidity, and reinforce tighter financial conditions beyond the overnight rate. Its effects depend on the pace, composition, and market expectations. I would distinguish QT from conventional rate policy, monitor funding markets closely, and avoid disrupting market functioning while pursuing the desired macroeconomic stance. Explain balance sheet reduction through maturing or selling assets, distinguish it from policy rate changes, discuss bond yields and liquidity, and mention the need to calibrate operations against market functioning. Question 11. How would you assess whether inflation expectations are anchored? I would use several indicators rather than relying on one measure. These include household and business surveys, professional forecasts, market-based inflation compensation, wage settlements, and evidence from firms' pricing decisions. I would focus on medium-term expectations because short-term measures can react to gasoline or food prices. I would also compare expectations across groups and examine whether inflation is broadening. Persistent upward revisions, rising wage price pass-through, and weaker confidence in the target would concern me most. In your answer, combine surveys, market-based measures, wage and price-setting behavior, household experiences, and medium-term trends, while explaining why short-term movements do not automatically indicate de-anchoring. Question 12. How do fiscal and monetary policy interact? Fiscal policy affects demand through government spending, taxation, transfers, and borrowing. Expansionary fiscal policy can support activity during weakness, but if the economy is near capacity, it may increase inflationary pressure and require tighter monetary policy. Monetary and fiscal authorities therefore interact through the macroeconomic outlook, even though their responsibilities differ. I would preserve the bank's operational independence, assess fiscal measures within the broader forecast, and communicate the policy mix clearly. Make sure to explain how fiscal spending and taxation influence aggregate demand, how monetary policy responds to resulting inflation pressure, and why institutional independence remains essential for credibility. Question 13. What are the main risks to Canada's financial system? Important risks include highly indebted households, a sharp housing correction, commercial real estate weakness, leveraged financial institutions, funding stress, cyber incidents, and climate-related losses. Canada's financial system is interconnected, so a problem in one market can affect confidence, credit supply, and spending elsewhere. I would assess both the probability and potential severity of each risk, examine whether institutions have adequate capital and liquidity, and consider how stress could spread through common exposures. Discuss household indebtedness, housing market corrections, leveraged borrowers, bank funding and liquidity, cyber risk, climate exposures, interconnectedness, and the possibility that risks become amplified through confidence or market channels. Question 14. What is the Bank of Canada's role in financial stability? The bank supports financial stability by identifying systemic vulnerabilities, analyzing risks, publishing assessments, and helping ensure the financial system can withstand shocks. It monitors household debt, housing, market functioning, and institutional resilience, while contributing to safe payment and settlement infrastructure. Financial stability is related to monetary policy but is not identical to it. A stable system improves policy transmission, whereas emerging vulnerabilities may affect the appropriate pace and scale of policy decisions. Focus on monitoring systemic vulnerabilities, conducting research and stress analysis, communicating risks, supporting resilient infrastructure, and coordinating with domestic authorities without confusing financial stability with day-to-day monetary policy. Question 15. Tell me about a time you used data to solve a difficult problem. In a graduate research project, I analyzed several years of regional employment data to explain differences in labor market recovery. I cleaned inconsistent definitions, merged survey and administrative sources, and tested whether results changed under alternative specifications. The initial pattern weakened after controlling for industry composition, which prevented me from overstating the conclusion. I summarized the findings in a short presentation, highlighted limitations, and recommended additional data collection rather than presenting a false level of certainty. Use a clear situation task-action result structure, quantify the dataset or outcome where possible, explain your analytical choices, acknowledge limitations, and show how you communicated the conclusion to non-technical stakeholders. Question 16. How would you handle conflicting economic indicators? I would first check definitions, timing, seasonal adjustment, revisions, and data quality. Conflicting indicators may reflect different parts of the economy or different points in the cycle. For example, employment can remain strong while forward-looking business surveys weaken. I would develop competing explanations, test them against additional evidence, and examine whether the conflict is temporary or persistent. My recommendation would state the central view, key uncertainties, and which upcoming data would most change my assessment. Be sure to mention data quality, measurement timing, revisions, leading versus lagging indicators, alternative hypotheses, triangulation, and the importance of communicating uncertainty instead of forcing a single definitive interpretation. Question 17. What role does economic forecasting play in monetary policy? Forecasting helps policymakers assess where inflation, growth, employment, and financial conditions are heading, which is crucial because interest rate changes work with lags. I would treat the forecast as a disciplined baseline, not a precise prediction. Models provide structure, while judgment incorporates unusual shocks, structural changes, and incomplete data. I would include alternative scenarios, identify the assumptions driving each outcome, and update the outlook as new information changes the balance of risks. Discuss forecasting as a structured baseline rather than a prediction with certainty, include scenarios and risks, explain policy lags, and emphasize model judgment, incoming data, and transparent communication. Question 18. How would you explain a monetary policy decision to the public? I would begin with the objective and the decision in plain language, then explain the main evidence behind it. For example, I would describe whether inflation is moving sustainably toward target, how demand and employment are evolving, and which risks matter most. I would avoid false precision, acknowledge uncertainty, and explain that policy affects the economy gradually. The message should be consistent across formats, accessible to households, and clear about what future decisions will depend on. Focus on clarity, the inflation objective, the economic evidence, the decision's rationale, uncertainty, likely effects, and avoiding technical language that could confuse households or undermine credibility. Question 19. How would you respond if your analysis contradicted your manager's view? I would first verify my data, code, assumptions, and interpretation before raising the issue. Then I would present the disagreement respectfully, focusing on evidence and explaining which assumptions drive the different conclusion. I would invite critique and test alternative specifications rather than treating my first result as definitive. If the team reached another view after discussion, I would support the final decision while documenting the analytical risk and any indicators that should be monitored. In your answer, demonstrate intellectual independence, respectful challenge, evidence-based reasoning, willingness to revisit assumptions, clear documentation, and commitment to the team's final decision after discussion. Question 20. What would you do in your first months as a graduate at the Bank of Canada? My first priority would be to understand the team's mandate, current projects, analytical standards, and decision timelines. I would review relevant research and historical policy materials, learn the data systems, and seek feedback early on both analysis and communication. I would aim to contribute through reliable research, transparent documentation, and concise briefing materials. As I gained context, I would ask thoughtful questions and suggest improvements supported by evidence rather than assuming I understood the institution immediately. Mention learning the bank's mandate and processes, understanding team priorities, building technical and communication skills, seeking feedback, reviewing research, and contributing carefully before proposing major changes. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.